Thank you very much, Chief, Chairman Bobby, Vice Chair Romy, President Toti, my fellow FEF fellows, friends, ladies and gentlemen, good morning. I have to thank Romy for providing us with a broad framework for understanding these issues within the context of the so-called trilemma. This is the trilemma faced by countries aspiring to implement independent monetary policy in a situation where they seem to be given only one option out of two. Keep their monetary policy independence with flexible exchange rate, but restrict capital flows, or free capital movement, but consider managing the exchange rate. Of course, the latest in the literature is that even if one keeps a fully flexible exchange rate in the face of globalized and volatile finance, it would also be requiring some form of intervention in the foreign exchange market and macroprudential measures to keep it effective. My job this morning is to simply follow through what Romy has presented and try to explain the linkage between inflation and the exchange rate. Should we be bothered when the peso hit 56 to a dollar yesterday? What about inflation, which at 6.1% and 4.4% for the first half of 2022, and I'm sure no one is going to dispute those numbers, has already breached the official targets. Okay, let me say in the beginning what the author Sam House concluded after writing tons of books nominated for the Pulitzer Award. He says, in literature and in life, we ultimately pursue not conclusions, but beginning. I hope after this seminar, we shall begin our journey of more understanding and more patience with the word. So, should we be bothered when the exchange rate hit 56.06 yesterday? That in the last 30 days, the exchange rate depreciated by 3 pesos. Isn't it that the exchange rate feeds into the inflation process? That is, the more depreciated the peso, the higher inflation we should expect. Well, our friend and co-FEF fellows, now Governor Philippine, was quite clear a couple of days ago, and I quote him here. We are a lot more concerned about the inflation effects of a more depreciated peso, given that we already have very high inflation. That's from Philip. I share the view of Philip that the BSP should already be concerned with a weak peso, not because of the inherent linkage between inflation and exchange rate, and it is decreasing, but because further weaknesses in the peso would add more inflationary pressure and in the process possibly disanchor inflation expectations. Yet, through all this, we can be ambivalent. Okay? We can be ambivalent because the BSP itself has shown that the exchange rate pass-through to inflation has dropped from the time that the BSP implemented the flexible inflation targeting framework as framework of monetary policy in 2002. It has yielded generally favorable results in terms of keeping prices stable. This is one of the reasons for the reduction in the exchange rate pass-through. The other reason, of course, is the increased participation of economies in global value chains. The Philippines per se has yet to join this club in a big way, but many of its major trading partners, including the US, Japan, Europe, and China, are key players in the global value chains. This would also explain the lower exchange rate pass-through. Before IT, for instance, the short-term ERPT, and it is here, okay, was 0.269. Okay? That's the first column. Short-term. Which means for every 1 peso of depreciation, domestic inflation went up before IT by 0.269 percentage points. Okay? During the IT period, it declined to only 0.042 percentage point, or an additional inflation of 0.042 percentage points. So if inflation now is, let's say, 4, and all things being equal, there was a 1 peso depreciation, you could add 0.042 percentage point to 4%. So roughly, if the peso has depreciated by 3 pesos, okay, from 53, 56 yesterday, we should expect some 0.126 percentage points. And I think that's where Jonas was coming from, or even Philippine. Quite small, but not when you have 10 peso depreciation, which could add 0.42 percentage points. Or over the long run, at 3 peso depreciation, exchange rate pass-through could easily add 1.26 percentage points. Or at 10 peso depreciation, 4.1 percentage points. It's all relative. So Philip has valid reason to be concerned and to act if need be. The BSP also estimated the impulse response of inflation to exchange rate shocks by breaking into sub-periods the IT years 2002 to the first quarter of 2022, to before Q1 2002 to Q4 2010, and after the GFC, Q1 2011 to Q1 2022. So what's the result? The response was significantly lower. Okay? It even came down post-GFC compared to the earlier decade. The conclusion is the same. Yes, we can effectively go slow on preventing exchange rate depreciation because the impact of inflation is not that large. However, when we see sharp movements within very short period, for example, 30 days, 3 pesos, or even 4, or even 5, and what will prevent it from going up to 10? And it is accumulating. The monetary authorities ought to act decisively. Market players might get a different idea that the BSP is more concerned with goals other than its own primary mandate of price stability. And in this sense, inflation expectations might be disanchored and it could entrench inflation even further. Well, I have to apologize for the small text, but I just lifted this from the BSP website. Okay? So that brings me to the issue of external competitiveness. Yes, sometimes it's meaningless to talk about cheaper peso or more expensive peso. It's all relative. Okay? So, we have this RER, or real effective exchange rate. And this is not something that we only do in the Philippines. This is something of global application. This table shows the nominal movement of the peso from 2017, the last 5 years, to 2021. Below, we have both the NEER, the nominal effective exchange rate, and RER, real effective exchange rate. This metrics of external competitiveness considers two important factors: the movement of the exchange rate and domestic inflation. Our own exchange rate and inflation performances are related to our trading partners and competitors' own performance in the same variables of exchange rate and inflation. From our perspective, we assign weights to them based on the importance of their external trade with us, both exports and imports. What is clear from this table is that both depreciated exchange rate and lower inflation constitute the elements of external competitiveness. We need to do both market-determined exchange rate and low and stable inflation, which should support the table that I just that I just presented with respect to the RER, what was supposed to show? The chart that I was supposed to show demonstrate the relative contribution of weak currency and low and stable inflation. If currency is strong, as we saw between 2019 and 2020, I am sorry it's not here, and inflation was not exactly low relative to those of other countries, both did conspire to weaken our external competitiveness. Nagsabay. Okay? In 2021, to the first quarter, 2022, as the black line, well, please imagine it, as the black line indicates, we gained external competitiveness because of peso depreciation and relatively moderate inflation in 2021. From all angles, we should be bothered by actual June 2022 inflation rate of 6.1% and the January to June 2022 inflation rate of 4.4%. So yes, we should be bothered. Okay? Given that inflation, because they are both in excess of the inflation target of 2 to 4% of the national government for 2022 and even for 2023. Given the forecast of 5% this year by the BSP, we have yet to see a further rise in domestic inflation for the last 6 months of the year. So if someone is surprised at 6.1%, he should wait for the next 6 months. Given that inflation has averaged 4.4 for the first 6 months, and the expected inflation for the year is 5%, and I think it will be upgraded or it will be scaled up as we go along through the end of 2022, and the policy rate is only 2.5%, we see the need for the BSP not only to continue tightening monetary policy for the rest of the year and the next, but to do it more aggressively. Monetary policy, remember, works with a long and variable lag. This chart and table clearly demonstrate the uptrend in consumer prices from the beginning of the year, February, to June 2022. The June 2022 inflation of 6.1 is the highest since November of 2018, when inflation rate also hit 6.1%. The 2021 inflation rate alone at 3.9%, you go down below 2021, and the average was more than 50% higher than the 2020 inflation rate of 2.4%. Our fear here is that high inflation might be entrenched unless our monetary authorities do something for the rest of the year. The trend and the early forecast of the BSP all combine to tell a singular narrative. Time to tighten. And when the last two came a little late in May and in June, the tightening would now have to be more aggressive. This is the cost of catching up. Ladies and gentlemen, as early as May of 2022, based on the May Monetary Policy Report of the BSP, this is available publicly, the BSP has already assigned a much bigger probability of 65%, now the first row, okay, that the average inflation rate for 2022 will exceed 4%. You know, in the US, there is a betting on the probability of moving and tightening by the US Fed, and they assign probabilities. Here, the BSP assigned probabilities on the possible inflation for 2022, given all the information available as of that day. So as of May of 2022, the BSP already believed 65% probability that is going to exceed 4%. It is quite surprising that it chose to tighten by only 25 basis points, and still another 25 basis points the following month of June. I can understand the reasons. Okay? At that time, there were apparent petitions for increases in wages and transport fares. In short, second-round effects have started to emerge. So if you want to make sure that inflation will not go beyond your expectation, you do something about it already. We don't share the view of some analysts that the BSP needs more time to sift through the data. The data are out there. Okay? A lot of labor groups petitioning for higher wages, transport groups asking for the subsidies, etc. So all the evidence of second round effects is there for all to see. Is Philip correct to be more decisive? Okay? I quoted here from Manila Bulletin, and he says, BSP to hike key rates by 50 basis points next month. Now that in all probabilities, we might be breaching the inflation targets for both 2022 and 2023, the question is the BSP justified to be more aggressive? Well, Governor Philip announced in no uncertain terms that the BSP is bent on doing a 50 basis points adjustment in the policy rate in the next meeting in August. For a central bank's forward guidance, this is quite forthright. Okay? The BSP seems to have abandoned its patience with monetary policy and has declared a war against inflation and the sharp decline in the exchange rate or the exchange value of the peso. I think it is obvious that I agree wholeheartedly. Now, I would have wanted to show the scattered diagrams before IT and during IT, okay? And this is about the Phillips curve, which was the subject of my column yesterday. And we have observed that the Phillips curve has started to flatten. Now, those who are incurably pro-growth, no matter what happens, we must take heart to recall that the Phillips curve in the Philippines has actually begun to flatten in 2011, at least based on our empirical studies after the global financial crisis. Now, what does it mean to have a flatter Phillips curve? A flatter Phillips curve has important implications for the conduct of monetary policy in the Philippines. On the upside, it implies that demand shocks, like an aggressive monetary policy, which you want the BSP to do, will not translate into large movements of inflation. However, on the downside, if inflation is above target, and right now we have the likelihood is that the actual inflation for 2022 and 2023 will breach target, bringing it down to the target level of 2 to 4% might entail a greater sacrifice of output. Thus, a flatter Phillips curve puts a greater weight on the commitment of the monetary authorities to price stability and in ensuring that inflation remains within target. Unfortunately, we seem to have reached that point. Both the peso is depreciating very sharply and very fast, while the inflation rate is rising to historic heights. What is going for the Philippine economy, of course, is that of the resiliency that it has gained all these years, thanks to the MEF. Congratulations, MEF. Many years of policy and structural reforms, as well as institution building. With a flatter Phillips curve, a more aggressive monetary policy response to higher inflation. So don't begrudge the BSP if it chooses to be more aggressive when inflation is going up, and less aggressive response to output deviations can actually result in better overall economic welfare. Now, no less than the BIS, the Bank for International Settlements of 2022, just recently, have also noted that the long-term cost of allowing inflation to become entrenched far outweigh the short-term costs of bringing it under control. That would have taken earlier, and the cost would surely be less. Now, just my last slide. Again, we missed one slide. But anyway, there's an additional point I wish to make. The BIS recently observed that the broadening price pressures may have caused households, and firms to move out of the zone of rational inattention. I want to focus on the challenge of the so-called rational inattention, within which inflation may not have much influence on their behavior, to becoming more attentive to just few inflation developments. This would influence household and firm behavior substantially. Now, in the case of Filipino households, and this is based on a empirical study, they are more attentive to price movements of basic commodities like food, rice, meat, fish, and milk, gasoline and fuel, utilities like electricity and water, transport, and alcoholic beverages. This finding is not surprising given that households tend to consume more of these basic or prime commodities relative to other goods. Thus, they see the prices of these commodities on a more frequent basis. But Filipino households are less attentive to developments in house rents and the cost of communication, recreation, and clothing, which could actually show more reasonable price trends. But their focus is on the prices of those basic commodities. So the high sensitivity of households and firms to just few commodities or services would motivate them to protect themselves from purchasing power losses or profit squeezes, and in the process contribute to higher inflation expectations. Demand for higher wages and price adjustments would therefore lead to inflation becoming more entrenched. So, ladies and gentlemen, I hope this brief presentation would contribute to all our journey of better understanding our economy. Mine is certainly not the last word on inflation and monetary policy, but I hope it's only the beginning of more inquiry and more humility. Thank you very much.